Hi, I'm Keith McCullough. Welcome back to another edition of Real Conversations, where it's my pleasure and privilege to welcome Mr. Lawrence Calcano, who is the founder of iCapital Network. Want to get into a lot of different things. He has a lot of experience, by the way, former partner at Goldman Sachs, 17 years there. He did the tech banking thing. He also did the research side, and now he is an entrepreneur on his own merit, I guess, is a good way to potentially segue into.
Yep.
Thanking you, first of all, for making the time. I appreciate
Pleasure.
it. Yeah, it's we both kind of come from the big place. Now we are at smaller places. Can you kind of walk through, what iCapital Network is, how many people, and what that's like versus your prior life?
Sure. Well, it's a little different. The going from a 35,000 person shop to a 32 person shop, it does have a set of changes you need to adapt to.
Exactly.
But although I think one of the consistent themes is making sure you have great people.
Yep.
Whether you're at 35,000 or 32,000, your success is completely contingent on getting the right people.
Yep.
And so we focus a lot on that at iCapital. But basically what we've created is a bridge between asset managers and wealth managers, right? So big institutional asset managers have typically, been targeting institutional investors, pension funds, et cetera, for, distribution of their products. And the high net worth community has really only episodically had opportunities to invest in those kinds of private equity funds and hedge funds. And there are a couple of reasons for that. The first is they just don't know who's out there. Just even understanding what my choice is. Yeah, they don't know. The other big issue is minimums. Most of these funds have very high minimums, $5, $10, $15, $20 million, which really put the asset class out of reach for a lot of, frankly, wealthy people.
Right. You mean the investment minimum that you put in just to get into the game?
Just to get in the game, you might have to write a check for $10 or $20 million, which makes it really difficult for most people. So what we've done is we've actually created a technology platform, I want to touch on that in a second, which allows the wealth community to see the highest quality, institutional grade, if you will, asset managers, but be able to invest not at 5 or 10 or 20 million, but at $100,000 increments so they can build out diversified portfolios, which is, if you're going to invest in the asset class, you've got to do it in a diversified way. So our platform allows them to do that. And I mentioned technology because it's really critical when you think about, CalPERS talking to Carlyle. That might be a $500 million discussion.
Yeah.
One manager, one investor. Technology's nice, not necessary. Take that same quantum of dollars and you try to raise that in the high net worth community.
Oh, geez.
That one investor might become thousands. And all of a sudden, all the workflows that you need to go through with every investor becomes difficult, if not impossible, to do manually. So technology enables that to all happen, where everything from discovering the fund, seeing the fund, and actually writing and signing your subscription docs right online is all handled.
It's all
through
done.
iCapital.
It's like, it's kind of, if you look at the old, like I affectionately call it the old wall, but if you go back to when you were back at Goldman Sachs, all the way back, you were like early venture capital. For those of you that don't know, Lawrence was like Forbes number whatever in the top list of venture guys that were making things happen. And here you are today versus that old structure where it's completely different. As opposed to the closed network of high net worth, you have an open network of high net worth.
Yes.
Can you go through, what that looks like? What people may not even know what the RIA community is or what the high net worth, community looks like relative to when you first started.
Sure. So the community is made up of a couple of different pieces. There are independent wealth advisors.
Yep.
So they would be the RIAs, registered investment advisors, that might operate independently. They might be aggregated in a firm like a Dynasty or a Hightower.
Yep.
Or you might just be an individual, what we call QP, qualified purchaser, that takes their own counsel.
So like a Hightower, for example, would be a good example of a place that came out of almost the old wall. They used to be, at what you would call traditional wirehouse, and now they have their own platform.
Exactly, and they've aggregated breakaway brokers, if you will, from the wirehouse platforms, as has Dynasty, and they've built out, really attractive businesses. And then there's still obviously a lot of wealth that's resident on the wirehouse platforms, the Morgan, the Goldmans, et cetera. And so when you break away and you've been at Merrill Lynch for so many years, you're used to getting the menu, right? Merrill has the big menu of hedge funds and private equity funds, et cetera. When you're independent, you don't have that menu.
Right.
And so iCapital actually provides that menu to the wealth community to see a menu, again, of high net worth, of private equity funds, hedge funds, et cetera.
Well, you actually, I mean, the menu at the big wirehouse is almost like you have to eat the whole menu in some cases. Some people have to go back and say, well, if I want to participate in this part of the IPO, I have to participate in this MLP structure, whatever it may be. In the independent platform, they get to pick and choose what their client really wants.
Yeah, and the best managers or wealth managers spend a lot of time trying to figure out exactly what their client needs, exactly what is the right set of investments from a return perspective, from a liquidity perspective, obviously from a risk perspective, and put together a portfolio that maps very closely to the needs of the client.
Yeah, it's interesting because we've already talked about, named a couple firms that would be using a place. We have 62 employees. You have 32 employees. I mean, they're actually using the services of people that came out of these big institutions, but we're still the same people. And that's kind of the one irony here is that you have the same people that are effectively finding a better and more efficient platform, is what you're saying at a bare minimum, but also a platform that gives you much more access to what you would ordinarily not have had.
Exactly, and we're trying to your earlier question about what's kind of different then and now, and one of the things that's the same is disruption, right? Some of the great companies that came out of the first wave in the late 90s and 2000 were disrupting the way businesses operated, the way they functioned. And really, to a great extent, what we're trying to do is disrupt this whole marketplace today and, get rid of manual workflows, right? Why is it that you need to fill out a massive subdoc?
Brutal.
It's brutal, right?
Brutal.
And then you make a second alternative investment, and you're doing the same document again. You're putting your name, all your biographical data, your risk information, your portfolio information, time and time and time again. And that's just really cumbersome. And by the way, most people, they'll send their FedEx, their doc back in a FedEx package, and guess what? They won't have made the second signature. They'll have left something blank. And then there's a whole new FedEx cycle that happens. And it's tough. We've had some wealth managers who say they get in their car and they drive over to their client's house and they say, please, can you have your husband and wife just sign this? It's right there in front of you. And so we make that all very, very easy by having it happen online.
I mean, but the rules and the laws have basically provided for that kind of it's not an opaque environment, it's just an arduous one, where it's much like getting a mortgage. I mean, you have to go in the old way and fill out the docs. I mean, that's basically, so now you're saying the electronic piece, let's set aside, which I want to talk about next, but the investment opportunities. But, at a bare minimum, you're just doing it faster.
Faster, easier, fewer mistakes. And what we're trying to do is let the wealth manager focus not on operations around these kind of investments, but on what they do best, which is focus on the client portfolios.
Yeah, that's exactly what we say. We may have the worst recommendations, which now we got to get into, but we might have the worst recommendations, but we're faster, because Wall Street has to put it through compliance. They have to, monkey it up and down whether or not they have a banking relationship. We either like it or we don't like it, and the high towers of the world are going to know that instantaneously.
Exactly.
So technology really enables that. Now the risk to being faster is that we're wrong, so how do you, maybe that's, an open, you can kind of have an opening volley there and just take your shot at how you think that the return opportunities are maybe better or in line. I highly doubt you'd say they're worse.
Yeah, no. What I'd say, Keith, is the process is faster. The thought process, however, or the decision-making process isn't faster, right? Because you cannot make a rushed decision around an investment idea, right? Because there's too much at stake. Making all the stuff that happens between that decision and after faster, you need to do.
Right. Because these are locked up investments. This isn't like my business, actually. It's longer term private equity venture business where you have locked up money for 10 years at a time in some cases.
Absolutely. Yeah, the range is a couple years in a credit fund to 10 to 12 years in a venture fund or a buyout fund.
It's a really big difference.
It's a big difference. And so you need to be, really thoughtful in first understanding what's suitable for the client. What is the right investment for their set of return needs and risk profile. But you also have to pick the right managers. And one of the things in the private equity asset class in particular is the dispersion of returns is enormous, right? So if you're looking at buying a big cap stock mutual fund or a bond fund, the dispersion of returns manager to manager is a couple hundred basis points at the widest.
Low.
Right? You look at a private equity fund, a venture fund, et cetera, you might have a 20 point spread, 20 percentage point
huge
spread between the top quartile and the third quartile. So that's the difference between succeeding and failing in an asset class, right? So, and David Swenson at Yale has written a lot about this, and they've got 35% of their portfolio allocated to private equity alone, right? And so having the right managers in your portfolio is critical. And to do that, you need to have the right information.
Well, that's a big one because it's so tantalizing for people, particularly in this kind of yield-starved environment where they're like, okay, private equity is up 13 or 14% in the last 10 years, and the S&P 500 is up 8, averaging through the cycle. But if you were to take who drove that 13% in private equity, what you're saying is it's quite narrow, and you need to be in the right. Much like being in the right stocks. I mean, there's a reason why the FANGs of the world, the Facebook, Amazon, Netflix, Google trade looks a lot different than a big cyclical trade. Getting that right is actually the biggest part. You're saying
it's critical, right? You look at the venture landscape. The top 20 to 25 venture capital firms have probably driven 80% of the returns.
Is that how big it is? Wow.
It's a massive concentration, and part of the reason for that is because when you're a new entrepreneur and you're figuring out kind of how do I want to raise capital, if you have any choice at all, you're looking at the firms that created all the firms, the FANG companies that you suggested, and you want some of that, right? I want to work with people that have had these mega billion, companies created, and maybe I'll have the same halo and glow in my company. So there's a lot of demand for those kinds of experienced venture capitalists, and I don't see that changing, frankly. And I think the same is true across the different asset classes. Whether you're looking at buyouts or maybe not quite as concentrated, but still being in the right managers is critical to success.
Well, now how do you take so basically let's go back to the economics of it. So now you're saying I can take a smaller slice. Let's say I go to the lowest slice, like $100,000.
Yep.
And what happens after that? Like, how can I try to have my best shot at getting invested in Uber before it becomes Uber? I'm just generalizing here, so using something somebody would know.
Yeah.
But how do I find my kind of I like chocolate ice cream, or I like vanilla, or I like Neapolitan? How do you make that decision on what bucket to put them into in terms of managers and investments?
Well, some of that is looking closely at the track records, right, and trying to figure out really a couple things. Who has built a replicable model? I talked about some of the glow associated with success, right? But who has a replicable model? And that can come in different ways, right? One way is who has what's the team composition of the manager? Are they a bunch of former finance people? Are they operating executives? Are they prior investors? What is the makeup? And what is the likelihood of, if they had a 25% IRR in their last fund, what's the likelihood that they're going to be able to replicate that in the new fund? So one of the things we spend a lot of time focusing on is what we believe is replicability of performance. And so if you were to disaggregate any one of these funds into the component parts of return, there's really a couple of major buckets. The first is financial engineering, right? People understand that. It's leverage, right? To us, that's a commodity. Being able to create returns through financial engineering is sort of interesting. If it's what you do and it's all you do, I'm not making that.
Some people wouldn't have agreed with you up until the last 6 months, but now that you have some deflation and deflation being bad for debtors, now they kind of get that.
They get that, right?
Kudos to you on that.
The second piece is multiple expansion. So you bought the business, you invested in the business at 5 times EBITDA, and you sold it at 10 times EBITDA. So that might be evidence of being smart about what you buy and how you buy it. It's probably also evidence of the third bucket, which we think is the biggest bucket, which is fundamental operational improvements. When you invested in the business, what was it doing in revenue? What was it doing in EBITDA and earnings? And when you exited it, what was it doing? Did you fundamentally improve the business during the hold period? And firms that actually have a lot of their return concentrated in that third bucket, in our view, that's the kind of evidence we look for replicability of returns, and those are the kind of funds we like to try to invest in.
Now given all your experience, you've seen so many different storytellers, so many different people that have tried to tell you that they could do this. But again, if you just break it down to who's got the most leverage, to who's actually doing the most fundamental change, and correct me if I'm saying this properly, but it's those that can show the most repeatable process in finding fundamental operating change in companies is what you're effectively trying to do.
Yes.
Now, do you upset people that, because there's a lot of managers out there that have purely capitalized on financial engineering, or they've purely ridden the multiple expansion wave on top of some financial engineering.
Yes.
We can think of some very public equities, for that matter, most recently that have imploded on those two metrics.
Yeah.
Once your financial engineering runs out, you get multiple compression. I mean, the thing blows up. So do you upset like managers out there by not qualifying them as actually being really good at what they purport to be good at doing?
So, I mean, I guess at a high level, nobody likes to hear no, right? But this is one of the important things.
No meaning because you say no, you can't be on my.
At the end of the day, we think we're doing the right thing for everybody. Because if we think that there's a risk that a manager isn't going to be the right manager for our platform, then the manager isn't going to drive a lot of volume anyway.
Yeah.
And so to some extent, by being upfront and honest and really identifying these are the concerns we have, we're helping that manager because it isn't going to be good for them to put something on our platform that doesn't move, right? And this, by the way, you talk about tying back sort of what we all did years ago and what we're doing now. One of the toughest things at Goldman when I was running the tech group was, companies wanted to go public. We had taken eBay public and Yahoo public and, a bunch of really great companies, Microsoft. And so people were interested in sort of somewhat analogously to my comment on the venture capital as to, can Goldman take us public? What does that mean, et cetera? And by the way, not that we got it right all the time because we all made our share of mistakes. But there might be a great company that just is a little early.
Yeah.
We liked the management team. We liked, what they were trying to do, but we thought, it's a little early to be a public company.
Mm-hmm.
And so we would say no for reasons that didn't reflect on the quality of the managers or even the quality of the idea or the opportunity. There might be another set of issues.
Yep.
And so how you handle that is really critical to, frankly, your franchise and the reputation of your franchise. And so during the bubble, we probably passed on 10 IPOs for everyone we actually did. But we always try to do it in a thoughtful way, in a very open and candid way, so people understood what we were thinking. And there were a number of times where 2 years later, the client would come back either with a different company or just later in the life cycle and want to re-engage the discussion because it had been a good experience, even though the answer wasn't necessarily what they wanted to hear. That's something I know I'll never forget, and because as our mothers all told us, you're going to be in the gutter more than you're going to be out of it, so you better be nice to people, right? And so you try to have that
I think that's
always operating behind
it's
the
so
scenes.
true, and it's so humbling when you go through it. But I mean, it's not your first rodeo. I mean, it's certainly not mine either. But you've seen, maybe it's a good way to maybe kind of wrap this up. I mean, you've seen 3 epic cycles in terms of multiple expansion at a bare minimum. You can call one, coming out of the 99, 2000, I affectionately call these bubbles, but I mean, 2007, 2008 leverage bubble, and whatever we're in now, and I don't think that you would disagree that there's not some form of a venture bubble out there, particularly if you go west. But
unicorns.
How much of that, how much does your experience actually really matter the most here? When you put your own eyes on something and you have 32 people at your firm, I mean, is that your greatest asset or your experience?
I think experience and judgment that comes from that, is probably every business person's greatest asset to if you use it and listen to it and you don't convince yourself that this time it's going to be different because it never is, right? At the end of the day, this stuff all ends and new cycles start and so forth. And I think one of the things that I try to do and we try to do as a firm is think about a situation not just in the moment, but in a longer time frame. And there are great managers that will do well in some markets and less well in other markets, and trying to figure out based on the cycle we're in, what types of managers are going to succeed. And it may not be that let's just keep layering on venture firms because look at all the unicorns out there, right? Because that doesn't last. None of this lasts. And there's a lot of people that have made that mistakes and made those mistakes, and you see it still today where people plow into these deals. Late stage growth investors plow into these deals at these really high prices, and what happens is often it happened recently with Square that the IPO trade is significantly below the last private round.
Yeah.
Now, by the way, that doesn't mean it's not going to be a good investment.
In fact, it looked like it gave, I mean, that day, as you know, they priced it at 9 instead of 15, I think last round.
And I think those guys were smart.
Yeah, the guys who owned it at 9 said, wow, I own it with the smart guys who own it at 15.
Yeah, exactly. and that's a good, you do need to think about these companies. There are a number, not a huge number, there are a number of companies that are truly disruptive and are truly changing the way industries operate. And every one of the FANG companies, Google, Facebook, every one of those companies went through a squirrely period, after their IPO.
That's putting it politely.
Right,
Facebook's IPO was a disaster. In the moment. I mean,
in the moment, right? And Google had some issues as well in terms of how that stock traded. But they're disrupting. So it may be that, the longer term trend and the longer term opportunity for that company is so profound that whether you're in it at 9 or 15 doesn't matter. Whether you're in Google at 9 or 15 or 115 doesn't seem to matter much now.
Yeah.
But that actually, it does point to one thing that's important to say, which is there are 5,100 public companies, okay? Of the 5,100, there's only a handful of real growth companies. Mm-hmm. And guess what? Everybody wants to buy them. Yeah. And those are the companies we've been talking about, right? Yeah. And so this is why we believe fundamentally that private equity is an asset class people need to look at. Mm-hmm. They may not decide to invest in it, but there are 130,000 companies by comparison that have $25 million of revenue or
Incredible.
More.
Wow.
It's a huge universe of companies.
Yeah,
right?
It really gets down to, and we try to preach this as much as we can as well. If it's not about financial engineering and it's not about some unicorn of multiple expansion, but it truly is about organic growth. There's a reason why expensive is getting more expensive, and why a platform like this is really interesting to me because it actually gives you some transparency and an early look, if you will, to start to see what you would have never been able to see this before. I mean, if you're sitting there at home with $500,000, you might as well go back into your home. You weren't going to get this chance.
Yeah, that's right. And the other sort of piece of it too that we talk to family offices a lot, and we just put out a survey that looked at 162 single-family offices. So it's a very big group of a very difficult to access universe, and we asked them about private equity, and we asked them, how many of you invest in private equity? About 63% of them invest, and of that group, 90% of them invest in funds. And 40% of them invest in directs. Yep. And that's interesting because there are a lot of people.
Directs mean they go directly into the company.
Into the Uber that you talked about. So that's a piece of the platform we're going to add.
Oh, you're going to add that?
We're going to add the ability to invest in direct deals because we know a lot of people want to invest that way.
Well, that's a big thing locally. I mean, locally, people know the companies. I mean, globally, by the time they become global, the cat's out of the bag. But locally, you can, people that do have the 100 to 500,000 that they naturally put down would be in something local.
Absolutely.
A team that grew up with 20 to 40, going up that curve to 100 people, everyone can see it. They're right there in front of you, and that's interesting.
Yeah.
Does that exist yet, where you can go direct to these companies?
It's harder to come by.
Right.
Where it has happened has been on some of the wirehouse platforms, frankly. Where, I know at Goldman, the Facebook was offered, and Google was offered, and Uber was recently offered, and a lot of the independent wealth community now wants to make sure they can offer those opportunities for their clients as well. Again, it's how do I replicate all the benefits of the wirehouse platform with the alternative product line, including directs. Yeah. That's really important for these independent wealth advisors.
Well, I think this is great. I mean, thanks for doing it, first of all. Somebody had to leave Goldman to do something like this, and you had to really take a shot. It's not easy, seeing your vision play through, and I think a lot of people now are going to be, the beneficiary of the transparency and of the process, and like you said, repeatable investment managers and their processes that you've found. So.
Well, there's a team of people, and the founding group, Nick Veronis, Dan Vinay, Phil Poole, John Robertshaw, these guys have been
a great team.
Focused. It's a great team of
you
people.
Can't make it happen. You have to have a little, you're saying a little team works, but it's got to be a great little team.
So last night I was at a Retired Partners Dinner for Goldman. It's an annual Christmas event, and it's a phenomenal event. But hosted, obviously. As
retired Goldman party, retired officers, everybody's like 45.
No, it was arranged, but the point I want to make is, and Lloyd said this, he summarized sort of what that group was up to, and there's a Fed chairman, there are Treasury secretaries, there's the president of Australia, there's some really successful people, and Lloyd said, if there's anything true about Goldman Sachs, is that, and any great company, is that no company succeeds or fails based on one person, right? And so, everybody is basically dispensable, right? And so everyone has to work together, and everybody, adds value, but no organization succeeds on the basis of one person, right? It takes a team, and that's true whether you're 35,000 or 32 people, right? You need
it's a great
to have
message.
the full
It's
team.
a great reminder, because that's what made it all work to begin with. So
Exactly.
Well, congrats.
Thanks. Thank you.
That's a real conversation with Lawrence Calcano. If you have any questions about it, please tweet me at Keith McCullough, and you can find Lawrence and his company right here on their website.